everyone, welcome to JIB CIB English Medium channel by Adda 24/7. My name is Aarti and I hope you all are doing good. So if you're planning for CIB December 26, then remember Vision series will help you to achieve your target. Because in this we are revising concepts which are very important from exam point of view. And make sure if you want to get the success, you need to watch each and every session which we are conducting under this vision series. And if you're visiting to our channel for the first time, do subscribe to it and share with your friends and colleagues so that they won't miss all the important updates. So today we are going to start with the new unit, that is going to be unit 15. Now under this unit we are going to talk about other valuation methods. Now what are valuation methods? See, already we discussed about the company's valuation. When you are valuing the companies, correct? What is the worth of the company? What is the total value of the company? Correct? And the previous unit where we discussed about the discounting, calculations. When we apply the time value of money, discounted cash flows. Means when you want to value any company, you are using present value, future value, time value of money. But what if we are not able to estimate the future values and present values? What if we are not able to identify the time value of money only? Then can't we calculate the valuation of a company? So the answer is yes. We can value even in the cases when you cannot estimate about your future incomes. When you cannot apply your future present value or future values. Correct? So in this particular situation, what are the methods that you can apply? So let's see. For the valuation, you have two methods. Number one, discounted cash flows. Means where you use time value of money. And the next one, that is non-DCF methods. So in our previous session, we discussed about this DCF models. Now today, we are going to discuss about non-DCF methods. And this is very, very important from exam point of view. Now, why it is important? Because in your JIB, in your CIB PYQs, means in your previous year attempts, there's number of questions in each and every shift. Surely you will get one or two questions from this. Okay, so important is you need to remember here formulas. If you know the formulas, directly you can score good marks. So let's talk about non-DCF methods. So what are the non-DCF methods you have? Number one, that is relative valuation model. Relative valuation model is the first one. Then equity valuation multiple models, enterprise value multiple models, book value and stock and debt approach models. So these are the 5 models which you can apply to calculate the company's value, to calculate the company's worth, or to value any particular share. Yes, chalo. So let's start with the very first one, that is relative valuation model. Now, let's take one example here. Okay. On your left side, you can see Mr. Arun, who is holding 2 acres of this land, and recently he sold this land for 10 lakhs. Okay. So Mr. Arun recently had one transaction where he sold this for 2 acres for 10 lakhs. Okay. And nearby, yes, in that locality only, my land is also there, which is 5 acres. Okay, here my land is also there near to Mr. Arun's land. That area is, let's say, 5 acres. Now I want to sell this land. So tell me, how I'm going to value it? I don't know what valuation that I need to keep here. So what I will do, I will search the recent transaction. Or I will ask to my nearby landowners that what is the current rate, what is the government rate, what is the current rate, how much buyers are ready to buy from for this land. So I am going to ask from nearby owners. Yes, or if there is any recent transaction, I will see that recent transaction. Like in this particular example, you can see the recent transaction is this 2 acres transaction, where 2 acres amount is equal to 10 lakhs. Okay, means if I calculate 1 acre, here is equal to 5 lakhs. Yes, so 5 acres is equal to, very easy, 5 into 5, that is 25 lakhs. Correct. So when I'm using the most recent transaction, correct, for the similar asset, for the similar product, where I can compare very easily. Now let's take one more example. Okay, let's say here this land, and I am also selling my 5 acres land. Now there is one building. Okay, and this building is also nearby my land only. So, and let's say this building recently sold from Mr. A to Mr. B for, let's say, 80 lakhs. So what do you think? Am I going to use this 80 lakhs for the valuation of my land? This is for the building. No, I'm not looking for the building. I'm looking for the land. Yes, so here you cannot just use any random transaction to value my land. So remember this part. For the valuation, you require the similar asset. For example, let's say I want to sell one phone. Okay, this is, let's say, Samsung phone. Okay, now tell me, can I value this Samsung phone based on washing machine? Can you do this? Of course, no. And you will select the similar model of the Samsung. Not even the iPhone, not even the Oppo, Vivo. Correct? So, this is what relative valuation. First, see whether your asset is comparable or not. Whether these two assets are similar or not. Yes, so based on the similar assets, when you are valuing your product, that is what? That is relative valuation. Relative valuation places an asset's worth in comparison to the price at which other comparable assets are selling on the market. Yes, so at the moment, which is the recent transaction you have seen, that you need to identify, and this is relative valuation. Chaliye. Now coming to your next model, that is going to be equity valuation multiples model. Now based on your equities, how you can value any company's value. Okay, so first is, that is PE multiple. Now all these equity multiples that we are going to discuss today, that is very important and even asked in your PYQs. So the first one is PE multiple. In simple terms, what we are doing here, we are calculating earning of the company. And how to calculate earning of the company? With the help of income statement. But what is income statement? See, in your module B, when we revise leverage unit, I told you that statement, sales minus variable cost gives you contribution, minus here fixed cost gives you EBIT, minus interest gives you EBT, minus taxes gives you EAT. Yes, then you if you don't have any preference shares, just divide this with the number of shares and you will get earning per share. And this earning per share is your earning. This is your earning. Means what? Means if you are investing, let's say this is ABC company. If you are purchasing one share, okay, what is the earning you are generating? That is given by earning per share, EPS. Yes, this is what earning means here. Then what is price? Suppose if I want to purchase the share, this is the income that I am going to earn. But if for earning the income, I need to purchase the shares now. So what is the amount I am paying for purchasing the shares of ABC? Let's say I purchased, basically current market price of the shares is equal to, let's say, rupees 400 for one share. Means if I want to purchase one share of this ABC company, I need to give 400. And based on this share, I am going to earn, let's say, rupees 5. Correct? I'm just giving you an example. So that is what price. Price is your current market price for purchasing a share. And after that, what is the earning that you can earn? Yes, so this is the relationship we see in PE ratio. Means, what is the relationship based on your purchase that you are incurring and the income that you are generating? So for the earning, how much amount people are ready, public are ready to actually invest in your company. Okay. So price earning multiple, also known as PE ratio, is a company's stock price to its earning per share. Yes, and it's a very common tool used by the investors to access the valuation of a company's stock, to know the worth of your company. People are using most of the time PE multiple. Before you invest, you need to check PE multiple for sure. Now, how to calculate it? For the calculation, we have this simple formula. Market price divided by earning per share. But in exam, they're not asking the simple one. They're asking this fundamental one. This fundamental formula. Okay. So you need to remember this fundamental formula. That says 1 minus B in numerator divided by R minus ROE into B. Now what is B? B is your plug back ratio. Now what is plug back ratio? See, let's say company total profit is equal to rupees 100. Okay, this is what XYZ company earn. Total profit. Now what do you think? Company will distribute whole profit to their shareholders, to their equity shareholders as a dividend? No. Company will not distribute 100% proportion to the shareholders. Company will reinvest in the business also, no? They will reinvest in the business to expand their business, correct? To multiply their production, to increase their capacity. Yes. So for the reinvestment, let's say company decided to use 70 rupees and remaining amount they will distribute among owners, let's say rupees 30. Correct? So here this 70 is your B. This 70 is your B. This is the plug back amount. This is the reinvested amount. Okay. So in simple terms, if I ask you, earning is equal to 100 and 70 is the amount which you are going to reinvest, then how much you have distributed as dividend? Simple. 100 minus 70. That will give you 30. Yes or no? Or in simple terms, if I denote this 100 as rupees 1 and 0.7 I'm reinvesting in my business, then how much I am going to distribute? 0.30. 0.30. Yes, so that is about the numerator. 1 minus B tells you that how much dividend you have distributed to your owners. Divided by R. This is the expected return I want. Okay, as an investor, what is my expectation? That is what R. Minus ROE. What is the return on equity? Means if you are a equity holder, how much you have invested, and based on that investment, what is your income? What is your income? That is what ROE multiplied by B. Yes, that is what we have seen here in example 100 minus 70. Okay, this is the formula which you need to remember. Now, let's solve a question. Very easy questions will come, direct questions will come. Just remember the formula and you can calculate it very easily. So, V&S company's return on equity is 20%, R is 15%, company's dividend payout ratio is 0.3, retention ratio is 0.7, calculate PE ratio. Now, as per the given data, can you apply the simple formula? Market price divided by earning per share? No. Means, as per the given data, we need to use our fundamental formula. Yes, and fundamental formula says, in numerator, we want the dividend which you have distributed. And how to calculate? 1 minus B. Yes, divided by R minus ROE into B. I hope you remember the Modbus rule. Yes, first we need to solve the bracket, then multiply, then here minus, then division. I hope you remember this Modbus rule, है ना? Open the bracket, then division, multiply, addition and subtraction. Correct? Chal. So here, as per the given, ROE is equal to 20%, R is equal to 15%, payout ratio, that is dividend payout ratio, is 0.3, retention ratio is 0.7. This retention ratio is your B. Okay, then what is DPR? DPR is nothing but the dividend amount. You know what you can say in this question? They have given you both the things. Means if you want to know what is the profit earned by the company, that is equal to dividend payout ratio plus retention ratio. That is 0.7 plus 0.3. That is 1. Correct? So, now which value we need to use here? See, if you are applying this 1 minus B, so you will be doing 1 minus 0.3. That is also giving you 0.7. Or as per the question, directly your value is given. No? So use 0.7 here. R, that is 15%. That is 15% minus, what is your ROE? That is equal to 0.20 multiplied by, what is the B here? That is 0.7. Wait a moment. Okay, sorry. Dividend payout ratio is 0.3. Oh, my mistake. So here in numerator, this is equal to here only have written incorrect. So this is your 0.3 and this is a 0.7. So if I want to calculate the DPR, 1 minus 0.3, that will 1 minus 0.7. That will also give you 0.3, or directly 0.3 is given. So take the 0.3, that is given already, divided by 0.15 minus 0.20 into 0.7. So just solve this and you will get the final answer. So what is the final answer here? That is, in numerator you will get 0.3 as it is. Let's solve the denominator first. 0.2 into 0.7 minus 0.15. Sorry. I'm sorry everyone. So here 0.3 divided by 0.01. So that is 30. This is your answer. Means based on your earning, people are ready to pay you 30 times extra. That is your dividend. This is your PE ratio. Okay, chali. Now, if you want to complete your remaining, topics also, then what you can do, you can join our paid classes. Okay, paid classes are already going on, and even new batches we are going to start from 7th August for your ABFM. So, if you want to continue your preparation through proper conceptual understanding, practice, then better to go with the paid classes. Yes, and for the maximum discount, you can use one coupon code, that is Y895. If you use this coupon code, you will get the maximum discount plus maximum validity. And this is the QR code for your ABFM group. Just scan this QR code and you will become a part of my ABFM group. And if you have any queries related to the sessions, and even if you have any problem while solving the numericals, you can ask me through this, Telegram group. And one more thing, if you want to download the PDF, you can download this through our virtual library. And virtual library link is given in our description box. Please check the link and download this PDF. And with this, let's wind up this session. Thank you everyone for joining. Take care and bye-bye.